Welcome to The Explainer. Today, we're unpacking a massive financial mystery hidden right inside AMD's Q2 2026 earnings reports and their recent 10K filings. Let's jump right into it. Okay, so in the second quarter of 2026, AMD reported a staggeringly huge revenue of $11.5 billion. That is a 50% jump year over year. I mean, for any hardware company, crossing that $10 billion threshold in a single quarter is just a monumental achievement. Management called it an incredible sign of strength across their operations, and honestly, they're not wrong. But here's where things get super fascinating. If revenue is breaking records left and right, why in the world did AMD stock actually fall? Well, we're going to explore exactly why a headline-beating quarter just wasn't enough for investors this time around, and what hidden metrics actually spooked Wall Street into a post-earnings sell-off. Because, in today's market, hitting the top-line number is really only half the battle. Section 1. The AI infrastructure pivot. To actually understand the Q2 reaction, we first need to zoom out a bit to their 2025 10K. AMD isn't just selling standalone chips anymore. Actually, scratch that. They're architecting entire systems to solve the world's most complex challenges across cloud and edge computing. It's a massive shift. Just look at this aggressive timeline. They acquired ZT Systems early in 2025 for high-level design operations. Then, they smartly offloaded the actual manufacturing footprint to Sanmina shortly after. And the big one, securing a massive 6-gigawatt GPU deal with OpenAI. These strategic building blocks were absolutely essential to setting up the record revenue we just witnessed. Section 2. Data center versus gaming. Now, these AI investments, they have completely warped AMD's financial DNA. We are looking at a fundamental, ground-up reshaping of the company's structure. The data center segment is absolutely eating the company. It drove over $6.7 billion in sales, fueled by these massive hyperscale deployments of their Instinct GPUs and 5th-gen EPC server processors. Meanwhile, client and gaming have shrunk so much in relative importance that they're literally grouped together on the balance sheet now at about $3.8 billion, and the embedded segment is just trailing behind at under $1 billion. So the crucial takeaway here is that AMD's business is becoming massively stronger at the data center, while the consumer segment is contributing way less profit per dollar of revenue. The enterprise AI engine is now driving the entire vehicle, accounting for a massive 58% of all revenue. Section 3. The gross margin problem. Okay, so if the data center is booming, why the hesitation from Wall Street? Well, we find our first big clue right here. It's a stark contrast between CEO Lisa Su calling it an excellent quarter with accelerating demand and the sobering reality that Q3 gross margins are guided to remain entirely flat at 56% on a non-GAAP basis. The market was really expecting those high-end AI sales to naturally lift the overall margin percentage, but the guidance says otherwise. And why does this matter so much? Well, at a $13 billion revenue midpoint projected for Q3, a single percentage point of gross margin represents $130 million in gross profit. Seriously, after you factor in the tax rate and share count, that single missing percentage point equals roughly 7 cents of earnings per share. When you're a stock price for absolute perfection, 7 cents is a massive deal. Section 4. The cash flow crutch. Sure, on paper, total revenue jumped 13% sequentially. But in reality, free cash flow plummeted 39% from Q1 to Q2, dropping down to $1.56 billion. Because of this, their free cash flow margin literally shrank by 11 full percentage points, down to just 14%. So where is all that money going? The cash is flying out the door to fund future AI infrastructure. Capital expenditures essentially doubled, skyrocketing 108% to $808 million. AMD is making a massive, completely necessary bet to compete in the full-stack AI ecosystem, but it's a bet that is heavily consuming cash and just hasn't fully paid off in margins quite yet. Section 5. The Helios hike. This brings us to the real climax of our analysis today, the technology AMD is aggressively spending all that cash on, Helios. Management made it crystal clear on the earnings call that the platform is in full production and initial shipments are beginning by the end of Q3. They are leaning heavily on this for a powerful double-digit sequential momentum narrative heading into the back half of the year. But Wall Street knows the truth. The December quarter is a far more important test for AMD than the headline-beating Q2 we just witnessed. The massive revenue numbers we just saw, those are in the rearview mirror now. To justify the valuation and that heavy capital expenditure, AMD absolutely must execute a flawless, high-volume ramp of Helios in Q4 and straight into 2027.
So, if you want to understand if the post-earnings sell-off makes AMD an attractive buy or just accurately priced, you've got to watch these 5 specific metrics in the upcoming quarters. First, we need confirmation that Helios is actually shipping on time. Second, we need to see that 56% gross margin finally expand. Third, we need a solid recovery in free cash flow. Fourth, we need clarity on the exact CPU versus GPU revenue composition over in the data center. And finally, we absolutely must monitor competitive losses, like that recent headline of SpaceX choosing NVIDIA over AMD.
I'm going to leave you with this final thought. If a 50% revenue surge isn't enough to satisfy the market, what happens if the Q4 Helios ramp stumbles? In this high-stakes AI arms race, is the market demanding a level of perfection that even record-breaking billions just can't buy? The pressure is totally on, and all eyes are firmly fixed on Q4.